Gentlemen, in today's video and this week's video, we're going to touch on something that you and I will feel, unfortunately, quite depressed about for this year. Now, that is actually, if you had thought, that is actually what the media, the bankers have been selling you all these years, as well as the exchange, that REITs make you good money, you'll be shocked. In today's video, as in our article for this month, yes, ladies and gentlemen, do go to GCP Global website, which is over here, and you can see all our archive articles for the last 32 years. Yes, we have been around for the last 32 years. So in this month's video, we are going to talk about how is it easy to lose money in REITs. Yeah, you might think, right, it's actually difficult to lose money in REITs, but in actual fact, the reality is that it is and has been easy to lose money in 2021, as well as the listing period of REITs since it started way back in 2002. Now let's go on to the article, ladies and gentlemen. Now this is the first page. You can see that it's entitled, "It's easy to lose money in REITs." Now what we have done is that as of end of last year, we already have 20 years of data. Now, in my book, ladies and gentlemen, that is actually making your millions in REITs. You notice that I have actually computed and analyzed for you the numbers until the end 2019. Now, in this particular article in January, I have actually computed the numbers until the end of 2020. That means giving you a 20-year history. Now, of course, I've excluded the newly listed REITs, that is actually DG Core REIT and Daiwa House Logistics Trust, because essentially they have less than 1 year trading history. So it is difficult to compute a CAGR, or computed annual growth rate for the REIT. So let's look at the 38 REITs that have been listed. You'll be surprised, ladies and gentlemen, that now this is the slide that shows that out of 38 REITs, 18 out of 38 REITs, that's almost 50%, ladies and gentlemen, have lost money for you. Okay, now, ladies and gentlemen, you notice that this is the IPO prices of all these 18 REITs. These are the IPO dates. These are the cumulative DPU that you get since the end of 2020. And this is the price at the end of 2021. You notice that this is the percentage change. This is the losses that they have computed or chalked up for investors. Yes, ladies and gentlemen, it's very disheartening that you notice out of the 1838 REITs are listed, 18 have lost money, and of the 18, 6 out of the 18, or 1/3, or 6 out of the 38, or roughly 20%, have posted negative CAGR, or computed annual growth rates since their IPO. Scary, right? This is despite including their respective dividend. Okay, and this infamous 6 will include ARA US Hospitality REIT, Lippo Malls, United Hampshire, Fraser Hospitality Trust, OUE Commercial Trust, and Cromwell REIT. Now, ladies and gentlemen, when we teach at GCP Global, we touch on the altruism in each of the REITs, and we tell you as what the truth should be. Okay, nothing that the media can play up, nothing that the bankers can sell you, nothing that the REITs can actually dish out in a format that they want you to see, neither did basically how the exchange wants to promote REIT as a platform to you. We tell you the truth as what the figures, the numbers, the performance should be. So if you're interested to join us for our next class, is on the 12th of February. Do sign up over here and enjoy the early bird discount. And of course, to continue to like our weekly videos, do give us a like, subscribe, recommend a friend, do send us an email at gcpglobalsg@gmail.com. Tell us your name, the contact detail, and the name of a friend that you recommended, so that you stand a chance to be a lucky winner at the end of this month when we do our monthly draw. for a special price. Now let's move on, ladies and gentlemen. Now, this second point, ladies and gentlemen, vehemently and succinctly tell us what we have been teaching all this last 32 years. That is, having the wrong REITs can destroy your investment portfolio. So once again, let's look at this table, ladies and gentlemen. Now this lists the 6 REITs that have posted negative CAGR. Now, what does it mean? Essentially, this means that the opportunity cost of investing in this REITs are very high. What you have done, and you have done better, is that you can get your capital back plus 2% interest rates if you have invested in, say, the opportunity cost in, say, the recently issued domestic bonds. Okay, so whereas compared to putting your money in this REITs, you notice, for example, you lose a range between 0 or 1% to 22% over the course of the years. And you can see that even this investing in liberal malls, which have a history of the last 14 years since its listing in November 2007, up to this day, you are still losing money on this particular REIT for an investor that invested during the IPO. Isn't this very depressing? Take a moment to think about it. So, ladies and gentlemen, you notice that in our upcoming class, we tell you that to position and to buy into the right REITs is the key in growing your wealth. And true enough, our historical figures and empirical evidence clearly states that. Because you can see, ladies and gentlemen, that in this particular slide, these are the REITs that essentially have continued to post negative returns, in terms of the share price at the end of last year compared to their respective IPO prices. You notice that 12, in addition to the earlier 6 out of the realm of 38 REITs, are sitting on losses. That means capital losses. Essentially, this means that if you had invested in this REITs since IPO, right, you are still sitting below the IPO prices. Yes, you are maybe posting a slight positive on the CAGR. That's because of the dividends that you're getting on a half monthly, or rather half yearly, or every quarterly basis. But yet, this may not still be sufficient, because if you look at some of those REITs that were listed 5 years ago, like Manulife, right? 5 years ago, you could have an opportunity of investing your money alternatively into, say, Temasek or GIC bonds, which were then trading at close to about 3.5% to 4%. Isn't that, and would not that be a better alternative? Then let's move on, ladies and gentlemen. Okay, you can see that our last point, nonetheless, is that yes, it is time and effort must be needed to find the REITs. You can see that this table, ladies and gentlemen, lists the number of REITs. And you'd be surprised, wow, if you use 10% as a cutoff, right, in terms of the CAGR over the years, there are only 6 REITs. Yes, ladies and gentlemen, only 6 REITs out of the 38 REITs, right? That's less than 20% that would be able to make the grade, right? Meaning that these are the REITs that is including Capital DC, Fraser Logistics Trust, MCT, MIT, Parkway Life, and Center Street. Now, these are the ones that have posted more than 10% CAGR since their IPO. Now, it's important to understand that using the rule of 72, if you are able to do or find investments that actually earn you 10% year in, year out, and if this trend continues, you can always double your money every 7.5 years. And that's what we look for, in guiding our student investors, which enumerate more than 8,000 across the world at GCP Global, right? We try to double your value of your REIT investments every 7, 8, 9 years, right? But doing that is not easy. It means a lot of conscientious work, which is basically what we do. And that's why we will present it during our classes. The next lesson on 12th February, you can sign up here and enjoy the early bird special. Okay, so let's not forget, the final lessons, what 2021 has shown to the REIT investor. One is that the first rule of making money in REITs is not to lose your capital. And the second rule, ladies and gentlemen, is, to paraphrase Warren Buffett, is that don't forget rule number one. All right, and that's what we carry closest to our heart at GCP. Okay, so before I give you the final lessons, I just want to update you on last week's video when I touched on what's wrong with the MCT and Mapletree NEC deal. And 1 week later, after I contacted MCT, the investor relations came back and tell me that, because my simple questions was this, how could you have used a 1-day VWAP as of 26th of December at the price of 2.0039 for MCT, which is already down from 2.17, the recent high, right, to price a 10 billion deal? And you know what they tell us in my reply? They say that the directors, the board of both REITs have spent time considering this before announcing it. So what is the answer to my question? My question was, how could you have used a 1-day VWAP of 2.039 to value a 10 billion deal? What is the justification? What is the basis? So do you think that they have answered my question? Well, I'll leave you to be the judge. Okay, so as you can see, ladies and gentlemen, even if you invest in good REITs, sometimes, a lot of things are unclear and you don't get clarifications. And that's what we try to do, to help you to seek the best clarification and details and rationale in analysis. But before that, let me just end by sharing with you the lessons that we learned in this latest article. And do sign up for GCP Global classes, as well as monthly articles. Subscribe to our channel, like and share, because essentially we're giving you wisdom on REITs weekly in our videos, as well as monthly in our monthly webcasts. And one of the lessons that we've learned here is that it takes a lot of hard work and continuous watchful eyes to have and watch the turning points, because the moment when REITs go into a downslide, you normally don't see them come back. Okay, so that's our first rule. 2 is that S-REITs have given investors good long-term sustainable returns. Okay, as what the 6 REITs out of the 38 have shown, but they are hard and difficult to come back. Thirdly, to be able to achieve what the 6 REITs have done for us, it is imperative for the investor to be looking and be able to pick the right REITs for your portfolio to achieve consistent and steady return over time. And that's what we try to do in our classes on 20th to 12th of February, as well as every quarterly splits. And then, most importantly, ladies and gentlemen, as our first 2 tables have shown to you, you can lose money and you can lose big on REITs, right? 18 out of 38 REITs, that's almost 50%, would have lost you money at the end of 2021 compared to their respective IPO prices, of which 6 of them posted negative CAGR, right? So you need to learn how to sidestep the bad apples when it comes to picking REITs. So once again, do like our video, subscribe, recommend a friend, do send us an email at gcpglobal sg@gmail.com. Tell us your name, your contact details, and the name of your friend, so that you can stand a chance to win our lucky